Good afternoon, everyone, and thank you for joining us for our discussion on how to be strategic with your charitable giving from a tax perspective. I'm Shannon McNulty, estate planning attorney and founder of the Village Law Firm, where we provide peace of mind to New Yorkers and their families. Today, we're joined by Randy Kaufman, a wealth advisor at Heron Wealth. Heron Wealth is a New York-based independent financial advisory firm that provides financial planning and investment advice to professional and executive individuals and families who have created thriving businesses and enjoy successful careers. Randy has a really impressive background that spans corporate tax law, investment banking, family office services, and she has a particular focus on financial peace of mind, family dynamics, and strategic philanthropy. So welcome, Randy, and thank you for joining us.
Thank you very much. It really is a pleasure to be here.
I'm so happy to have you here today. And I have to say that when Randy and I were preparing for this discussion, there were so many interesting topics that came up in connection with charitable giving and philanthropy and how to think about it, which we definitely cannot cover all in this discussion today, but I'm sure we'll have future discussions to cover more of those kind of even bigger ideas. So I really look forward to that. But I think we're going to have a great discussion today.
You too.
So in the interest of everyone's time, we're going to be focusing particularly on how to plan your giving in a way to maximize the tax benefits that the government provides us to incentivize charitable donations. A lot of our clients, both at the Village Law Firm, and I'm sure your clients, Randy, they give to charity, but they might not be thinking of it as being part of their overall tax and financial planning. They might just write a check every year to their favorite charity, but there are ways, and any kind of giving is great in my opinion, but there are ways that you can do it if you want to be strategic from a tax perspective that can save you money and allow you to give an even greater amount to your favorite charity. So, first I want to talk about the timing of donations. So Randy, can you tell us a little bit about why the timing of your charitable donations is important?
Absolutely. And before I do that, if you don't mind, I just have to point out I'm a recovered corporate tax lawyer. And if you're not charitable, it doesn't make sense to give money to a charity. You give away $1,000, you get $1,000 deduction, you save a couple of $100, but you're still out money. So the reasons to give, in my experience, first of all, money doesn't make people happy. And everybody knows that. And Shannon and I especially know that you need a certain level of income. But what the studies show is experiences make people happy, that marriage, community, and charity, if you are philanthropic, it's also a great way to teach your values to your children. Charity is a wonderful way to help people and causes that you care about. And it's also a great way to create a legacy, and it doesn't have to be millions of dollars. You can sit around the dining room table with an 8-year-old, as I've seen, and talk about the benefits of charity and take them to a soup kitchen or take them to an animal shelter and say, you have $100, what do you want to do with it? So it's a wonderful way to create a legacy. Timing is really important though, as Shannon says, and I've seen entrepreneurs, that's how I got my start in this business, walk into my office. They sold their company last year, didn't want to deal with lawyers and accountants and you people in your suits. And then they come and it's like, well, what can I do now? And it's like, call your accountant, they'll fill out your tax return and they'll tell you how much taxes to pay. So if you come to your advisors early, you can really make a difference. And please think about it when there's a large income event in your life. Selling a business, winning a lottery, selling a piece of art, whatever it is, that's the year to call the advisors. Quickly, in terms of the timing, let's talk about how you get the donations. And there's certain things, rules for deductions, bunching, and then really think about donating in years where the income is high. The other caveat is when you're going to give away a lot of money, it's so easy to say, well, I bought that Apple stock in 2009. It's up like 4,000%. So I'll sell it and give that away, whatever is left after tax. Well, that's great. As Shannon said, it's wonderful to give money away, but if you want to make an impact, you can reduce your taxes by take that out stock, Amazon, whatever it is that's appreciated. Call your wealth advisor and ask them to transfer to a charity, or you get the transfer instructions. So all of the gains, it could be, let's say on $10,000, you bought the stock for $1,000, $9,000 of gains are avoided by giving the stock to the charity. If you sell it, you're going to pay thousands of dollars in taxes, and then you'd have less to give them. Because they're a charity, they take that stock in kind. They sell it. They don't really want to keep your stock, whatever it is, but they sell it tax-free. So that is a really simple, wonderful strategy that so many people don't even know about.
So, Randy, before because I feel like we're really getting into so many really important and strategic types of planning here, but kind of just to bring it back a little bit more simply, just to give us a broad overview for people who may not be familiar. And this is actually something that changed in the last couple of years in terms of the rules, the tax rules of when you can get a deduction for your donations. Like, can anybody just get a deduction for the donation? Do you have to have a certain level of income that it makes sense for? How does that work?
Now, that's a really good question. Unless you have a certain level of income, there's nothing to deduct it against. And so what the IRS does, I mean, anybody can give a small amount of money, a couple $100s, and get a deduction for that. But what the IRS does is they impose limitations based on your adjusted gross income and what you're giving and to whom. And so the really simple thing is when you give cash, write a check to your standard nonprofit, you can deduct 60% of your adjusted gross income. So if you make $100,000, let's say you're feeling really charitable that year and you have extra money, you give somebody $70,000, you can deduct 60, but then that $10,000 doesn't go away. You can carry that forward for the next 5 years. So those are the simple rules. When you get into two things, giving to private foundations and not charities, and not giving cash or publicly traded stocks and bonds, the level of complexity increases greatly. The limitations, I don't want to go through it all of them now.
Okay, so let's just start because there's so many different complexities to this. Let's just start with cash. So if we're just going to write a check, I'm going to write a check. I have $50,000 in income, and I write a check for $2,000. Is that going to reduce my taxes?
So that is a great question, Shannon. A lot of people think it would, and that gets into something else called bunching. So now the IRS has a standard deduction. Anybody, if you're single, it's slightly over $12,000. So you would have gotten that deduction anyway. Please go ahead and give that money to charity. But here's a little trick or strategy, whatever you want to call it. Let's say you want to give $2,000 away every single year. And let's say it's a year where you got a huge bonus. You can put $20,000 or something over the standard deduction into a donor advised fund. We're going to talk about that later. You get the deduction this year. You get to use everything over the $12,000, really itemizing it. And then you can give that $2,000 a year out over the next 10 years. Never right now under current rules, or all of it whenever you want.
So if you give up to the standard deduction is the amount everybody is entitled to deduct from their taxes, right?
Yep.
And so if you give under 12,000, then does that mean that you're not getting any deduction?
It's not really an effective use. And so to make it more effective, because you could give 10,000 every year and you're not really getting anything. But here's the other thing. You can do a big deduction to a donor advised fund end of the year, and then you could give 10,000 away December 2021, and then 10,000 away January 2022, and in 2021, the year of the gift, you've gotten a much better use of your charitable dollars.
Okay, so if I give $10,000 a year, I might not get any tax benefit. And it's great the charity is getting
Right.
the $10,000 a year. That's wonderful. But if instead of giving $10,000 a year, I gave for 5 years, I gave $50,000 in 1 year, then I would get a charitable deduction. Is that how it works?
Absolutely.
Okay.
That's exactly how it works. If, and there are limitations for 1 year, but if you hit that limitation, it's okay because you have 5 more years, you can carry it forward.
Okay.
So that is how that works. I will say, pretty interesting rules if you're giving crypto and art and a cigar collection and antique cars and all that other, we call them hairy assets. That's when you really want to call an advisor and understand the rules before you make the donation.
Okay, great. Okay, so if we're just giving cash, that what we really need to know is how much we give each year and whether there's going to be a deduction, whether we should just save all of our donations for 1 year. We could have the same amount of gifting, but it would benefit us because we then get back quite a bit amount in terms of a tax benefit. Yeah, okay.
Exactly.
Okay, so timing of donations then is pretty important, it seems.
Very important. It's also, before a sale, really important to get your advisors involved because there are lots of things we can do if you're selling your company, months before. I had a client who had a stock that was hugely appreciated. He founded the company and he held onto the stock. It went public for like 20 years. But finally, he found out a private equity firm was buying them and they were all getting cash. So we called with plenty of time, months in advance, and we got the team together and the accountants to run the numbers and figured out in his case, it made sense to give some money to his private foundation and bolster that up, as well as he worked with 2 different donor advised funds. And we saved him hundreds and hundreds of thousands of dollars in taxes
Can
by
you
being
tell us what a donor advised fund is?
donor advised fund. Is a very simple version of a private foundation. People always say it's like having training wheels, and it's simple. You create a pool of money at a nonprofit. Schwab has a branch, Fidelity has a branch, Vanguard, all the big custodians. You can create a donor advised fund there. There are local donor advised funds. There are community foundations in each community that create a donor advised fund. So with as little as like $2,000, 10 minutes, easiest thing in the world you're going to create. You go online, you fill out a form, you send over $1,500, $2,000, and that money sits there. You get a deduction when you put the money in. So it's a great strategy for this timing issue, Shannon, because let's say there's a nonprofit I've gotten to know recently. I might give them $10,000 or 15, but I want to test the waters. I want to see what they're doing. I want to evaluate the impact, but I need the deduction now because I got that huge bonus this year because I did such a great job. So very quickly, I could put $20,000 into a donor advised fund, get a $20,000 deduction this year against my taxes in case I don't get that bonus next year. And then the rules with a donor advised fund, the money, you can invest the money and you can grant the money to nonprofits, but they have to be a valid 501c3. It is the easiest thing in the world with technology. There are great websites. I also really like it for 2 reasons. I was going on my DAF the other night to look at Ukraine.
And DAF is just to
donor advised
clarify, donor advised fund is kind of a industry term for it's a DAF.
And so I was on and I saw all these charities for Ukraine. And I was able to do some research. They do make sure that it is a valid 501c3 organization, so you don't violate the rules. And then the other thing I like is a bookkeeping function. It doesn't sound important, but I've been helping nonprofits, some of them for 25 years, and I can go in and see my giving history. And that's a really nice feature. Plus, it can be 2 in the morning. I can't sleep. I want to make a donation, and I just go bing, send my money there.
Great. I also like donor advised funds. One of the things that it comes up with in my planning with clients is they want to leave a certain amount to charity, but they're not sure which charity it is that they want to leave it to. And they don't necessarily want to have to redo their will, redo their trust every time they change their mind about which charity or a percentage of which percentage goes to which charity. And so by a donor advised fund, sometimes I recommend you could set up a donor advised fund and leave the money to this donor advised fund and change the instructions on that fund at any time with respect to what your wishes are for how it gets distributed when you're gone.
That's a really good point. The other thing is you can designate your children as your successors. So if you're charitable, to me, it's a wonderful gift. Instead of having, money I'm inheriting all come to me, it would be a wonderful gift to have a pool of money that says, Randy, you and your brother, or if I had kids, you guys get to designate that to different charities. So that's also another benefit. You don't,
Definitely. I think in terms of legacy planning, so, and you can start during your life, and this is what makes it really nice is that during your life, you can put money into this donor advised fund. And maybe when it makes sense, you put a big, maybe you have like a big event that makes sense for you to give the money to charity in that year. So say you have like $100,000 in the donor advised fund, and you can work with your kids to each year to talk about as like a family where you feel like that's most needed and where you want it to go to, and come up with some sort of thoughtful ways of deciding who gets what, who makes those decisions. And it's just a great family activity, I think. And then it's also something that I think one of a concern after we're gone is like, how will our kids continue their relationships, right? And because we all know after parents are gone, sometimes the siblings grow apart. And if they have something that every year they have to talk about and make decisions about, it gives them something, an activity to engage with, and to also just carry on the values that hopefully you've instilled in them as to giving to charity and giving back. It gives them a nice way to continue that.
Shannon, I couldn't agree more. And as a wealth advisor, some of my most joyful moments have been 3 generations sitting in a conference room talking about what to do and with this pool of money in a donor advised fund or in a family foundation. And the learning goes in different ways. It absolutely, I beg my clients who are my age to open their mind to listen to the younger generation about some of the things that they want to do. I remember we had a older client who wanted his name on buildings, and that was fine, but his kids really criticized him for that. And he listened, and we were able to compromise, and they really wanted impact investing in the family foundation. And because they had an outside moderator, which is me, they listened and they were able to really come together, try the impact investing, pay attention to the grants. And I always tell my clients, if you're going to bring in the next generation, that's great, and you should, but please give them a voice and some money. Don't just lecture them about your charities. And it really can work beautifully.
Yeah, I think that's so nice. And so one of the things, there's often questions about a donor advised fund or a private foundation. And so a lot of the things that we've talked about, you can definitely do with a donor advised fund, which I think a lot of people think you need a private foundation to do. When does a private foundation, how is a private foundation different than a donor advised fund? And when does it make sense to do the private foundation instead of the donor advised fund?
Yeah, it is very different. And part of it is the administrative cost. But a private foundation, like a donor advised fund, it's IRS sanctioned. You get deductions. Your limitations against your adjusted gross income are a little bit more severe. It makes sense, and I've thought about this a lot. People used to say over $5 million. And I always ask myself, is that true and why? And it's like, it's really not true. It depends what you want to do. If you want to run, I mean, you are running an entity when you set up a family foundation, or you should be. There are tax returns due every year. The legal documentation is expensive. You're supposed to have board meetings, take minutes, and it can be great. You can get outsiders to run them, and that's fine too. And there are real reasons. Then you say, well, why would I ever have a private foundation? It's more expensive, it's more cumbersome. So if you want to do something called program related investments, and I have a client of mine very focused on the arts and social justice. And so he liked lending money he lived in a smaller town, to theaters in his town. And we would structure the loan, and they were low interest rates. And then he'd decide, okay, I lent you $10,000, you know what, 5,000 is a gift and 5,000 I won't pay back. Let's restructure the loan. You can't do that kind of things in a donor advised fund. The other thing is, if you have kids, or you want to sit on the board and you want reasonable compensation, because the IRS is going to police that. You can't put your child on the board of $1 million foundation and pay them $500,000 a year. But let's say it's a reasonable compensation that's perfectly legitimate. You cannot do that with a donor advised fund. So that's another benefit, I think, of the private foundation. And I've seen that where you really have a large amount of money, very capable adult children, and you want them on the board to run it.
Right. So you can have kind of the family that be their job if you
Absolutely. As long
wanted
as you
to.
can show it's reasonable compensation. The Attorney General of some states pay attention to private foundations. Some states, they don't. Private foundations have a host of these rules called self-dealing rules. And it's good to have an advisor who can make sure you don't violate them. They were put in place for very good reasons. But as long as you understand the complexity, and you also can't be anonymous, you have to file an annual tax return so people understand what you're doing. But as long as you understand the complexity and you don't mind, there's a trend that I've seen over the past, I'd say 3 years, of people having a DAF, and probably maybe larger, and then a family foundation for some of the reasons I've discussed. And you can really have both of them.
So there are a lot of really great options in terms of if you want to have that entity to help with doing planning for your family, doing charitable planning, and having your loved ones involved. You could do that through donor advised funds, and you could do that for a private foundation, which I'm guessing gives just a little bit more flexibility and control in terms of what you can do with that.
Yep.
Great. So I want to go back to one of the things that you mentioned before, but I want to get a little bit more into this of what kind of assets that we give to charity and why that makes a difference. So I was talking about, writing a check to charity, and then you mentioned giving stock to charity. Why would you do that? It seems so simple to just write a check. Why would I, call my broker or go to my E-Trade account or whatever and try to
Right.
gift stock to a charity? That seems more complicated. Why would I do that?
A little more complicated. It's not really all that hard. You can just call the charity and say what are transfer instructions, and then call your broker and say, send, 5 shares of Amazon over. The real reason is it is a great way to maximize your impact. So I was lucky or smart to buy Amazon and Apple in 2009, just because I was like, how much cheaper can this stock get? And now it's up thousands of %. And so every $10,000 of Amazon stock that I use avoids capital gains, in my case, on $9,000 of gains at a 20% rate. So you can avoid those gains, and then the charity gets the stock. I get the same deduction. The charity gets the stock, they sell it, and they don't, so it's really, you allocate between yourself, the IRS, and charity. That's what I've said to my clients over the years. And here you're allocating more to charity. And as somebody who gets very focused on helping clients think about the impact of their giving, when there's more money, you can generally make a bigger impact. So it's really such a knee-jerk reaction. And if it's $200 and if it's a bike ride, I'm always like, just please send a check. But if it's over $1,000 and if it's appreciated and long-term, so you've held it for over a year, at least call your wealth advisor or your accountant. And there, if you give it to a public charity, you get a 60% limitation. So you can deduct up to 60% of your adjusted gross income. So it's really beneficial.
Okay. So just like, let's work this out a little bit in an example. Say you bought Apple stock when it was worth $10 and say today is worth $110. And so if you sold it today, you would have a capital gain of $100, right? And then you would have to pay what, $20,000, or I'm sorry, $20.
$20.
Yeah, $20 in taxes. And then after that, you could use those proceeds and then give to charity.
Exactly. And thank you for using easy numbers. I was like, oh no, I'm gonna have to get out my calculator.
And try to think of numbers we could do in our heads, right?
You know me.
And I'm still even writing them down, so
Okay.
makes you feel better. Okay, so if we did that, we sell the stock and then we say we have the proceeds from $110 minus the $20.
So you have $80.
So we have, or $90 because we have the $10 that we had put in originally.
Right.
So we'll say we get, we pay the $20, we have $110 that we have as the proceeds. So we end up with $90. Then we give that to, we write a check, we give that to charity, and we get a deduction of $90.
$90. And the charity only gets $90.
Yeah. So let's take it the other way. If we instead took the $110 stock and gave that to charity.
They get $110. Yeah. So they get the stock. They really don't want, most charities would sell it. And then they have $110 because they're nonprofits. It means they basically don't pay taxes. So they get more money and you're making a bigger impact.
And also our deduction would be higher, right?
Yeah.
Our tax deduction. So we would get a tax deduction for $110.
Right.
The charity would get $110 instead of $90. So it seems like this is why this is such a great leveraging tool if you do have appreciated assets, appreciated stock, or other appreciated property, to be able to give to charity in a way that is so impactful.
One of those things, I mean, I recently had a client whose doctor say that can't be. It's just, no, you're wrong, Randy. I'm like, okay, I have been doing this since 1998. I really know, I mean, I've done millions of dollars, but it's just so simple and it saves so much money. He just didn't believe it was possible.
Yeah, I had my dad say the same thing. I said, I have a master's in taxation, Dad. Master's in tax law. He said, you don't believe me? He's like, no, I really don't think this is right.
Right, you must be crazy. Yeah,
this is a lot for what he thinks.
That's very funny.
Or he's just I think it's just he's very stubborn.
And honestly, it's not very hard as a wealth advisor when the clients call all the time and move it here and there. We just say, great, get us the instructions and we send it over. A broker, if you don't have a wealth advisor, can do it very easily. It's one of those giant loopholes. And the tax law, I've said for decades, it's not logical. It's codified. It's, there are all kinds of strange tax rules, and it absolutely benefits people who have good tax advisors.
Absolutely. I get constantly, why is it like this? And I can't really tell you why. It's just that this is what it says in the tax code. Often these rules are done by people who didn't totally understand what they were doing and were done at different times. So you have tax rules that were implemented in 50 was that original like big revision, 1950 something. Then you have things that were added on every decade. Then a big big change in 1981, and more changes, more changes, more changes. And so some of the things that they had done originally don't really fit with what they are adding in, and so you end up with just this hodgepodge of rules, some of which make sense, and then some of which it's just there, and we just have to navigate that and do the best we can with it. But it does give us these opportunities for making an impact for charitable purposes. And the other thing, we were talking about Apple stock, which is a very easy thing, or very sort of more simple thing. But if you're selling a company, that was another, I think, event where you mentioned that could be a great opportunity to do this kind of planning.
Tremendous amount. When I first got into this business, I was up in Boston working with a lot of entrepreneurs, and love working with entrepreneurs, and tremendous opportunities. Say, well, before you sign the contracts, before everything is set in stone, let's look at what makes sense. One, for just estate planning, which are, giving often lower asset values to the next generation. And then also on the charitable planning, and does it make sense if you're merging with a public company and you're going to have public company stock, it makes sense to hold that and let it go higher and then make the donation. So it's very complicated, but it can save hundreds of thousands of dollars. The big rule there is check with your advisors early and often. And I know when you're selling your company, it's like a baby. You are totally in the moment, in the groove. You don't want to talk to anybody else. But that's when I've seen people come and I've said, well, if you had just checked with us 3 months ago, we really could have saved you a lot of money. And there are a variety of techniques, private foundations, donor advised funds, again, depending if it's public or private, but a donor advised fund can make a lot more sense with private stock than a private foundation. There are these other split trusts, we call them, charitable remainder trust and lead trust, all of which make sense to think about. You can say no, but be educated before you sell your company.
Yeah, I think it's such great advice. And that's just such a recurring theme, I think, in financial planning and estate planning, so many different types of planning, that doing things and thinking about things and talking to professionals before any of these transactions just can save so much in terms of aggravation, in terms of money, in terms of the best structure of ways to do it. We're not cleaning up afterwards, and we're not telling clients, oh, it would have been great, we could have saved you so much if you had come to us 6 months earlier, or even however long before. So
even a simple one, I helped a client in 2021. He sold industrial real estate. It was one of the rare real estate asset classes in COVID that did very well, and got him to a really good accountant. And he did a $300,000 donor advised fund in the year of the sale. And he has no intent of giving that money out right away, but he's very philanthropic and he'll give it out maybe over the rest of his life. But he saved a tremendous amount in taxes by doing that, as opposed to close the sale next year. Hey, Randy, hey, Shannon, how do I minimize my taxes? And you need to be in the right tax year to do that.
yeah, and there's a simple thing that I wanted to ask you about, because I do read a lot about this, of giving from your retirement account. Can you tell us why, if that's beneficial, and why?
Generally beneficial when you're 70 and a half and older and you're taking out required minimum distributions. This law came into effect a couple of years ago. You can give it has to go directly from you to the nonprofit, but up to $100,000 to an operating charity, and it's called a qualified charitable distribution. It is very beneficial. You save the tax you pay on the IRA distribution. And yes, you would get an offsetting deduction, but the way the limits work, it's better to just make a direct transfer. Let's say you do $100,000, that can count as your required minimum distribution for the year, which is very nice. It's not included in your adjusted gross income. You don't need to itemize to get a tax benefit from this gift, really, and it keeps it might make less of your Social Security benefits taxable. It might help you avoid Medicare high income surcharges. So it's very beneficial. And I see that done a lot with my clients in their 70s. It's, again, Shannon, like transferring stock, it's very easy to make one of those direct transfers.
Okay, so that's just a nice, simple tip as well. If people are looking to make a gift in a way that's smart for tax purposes, just some of the simple things. Okay, so we are reaching, I think we're beyond our time, which I knew because there's so many great things to talk about. But just to wrap up, if there were maybe, let's just give 3 main things for people to keep in mind about their charitable giving and how it can be tips for them for tax purposes of how it can be helpful.
So I would say the before you sell appreciated stock, if you're philanthropic, consider giving stock, especially over $1,000. I would say think about the IRA benefits if you're taking required minimum distributions. And then I would also really think about the donor advised funds because they're easy, they're efficient. It's a pot of money that you can use going forward. And honestly, I find it easier just to put Apple stock in my donor advised fund, go online when I want, and send it out to my favorite charity.
Great. I love that. Okay, great. So thank you so much for all of this great insight. I want to open it up for questions. So if anybody has any questions, if you just want to either put that in Q&A or raise your hand, we're happy to address anything that that you feel like might be helpful that we didn't cover, or to clarify something that we did cover even. Okay. So there is a question, are there tax benefits to leaving money to a charity in your will? I would say that only if you have a taxable estate is that going to provide a tax benefit, because there's really no taxes. If you have below the exemption amount, which currently in New York is around 6 million, federal level, depends on when you die, but somewhere between 6 million and 12 million. If you're below that amount, then there's no tax. So there's nothing really to deduct. But if you do have a taxable estate, anything that goes to charity through your will or in a living trust, anything upon your death, then that gets subtracted from the value of your taxable estate. And also, I was going to mention as well that that's another great way that to take advantage of the retirement accounts, the IRAs and 401ks, because that's something, even if you don't have a taxable estate, any distributions from those accounts are going to be taxable to your beneficiaries when they're distributed. So if you leave the money, if you name a charity as a beneficiary of your 401k or your IRA, then that charity doesn't have to pay those taxes. They get the entire amount. So that's a great way. It's sort of something a lot of people really can benefit from. It doesn't really matter whether you have a taxable estate or not. You have anything to add on that, Randy?
No, just well, I think it really points out the benefit of asking the questions, because I've seen situations where people have a will and they leave money in the will to the charity and the IRA to the kids because they think the kids want the regular income or whatever it is. It's like, yeah, okay, it sounds great, but it was backwards of what you would really want to do because of taxes.
Absolutely, absolutely. Okay, so that was a great question. Anyone else before we wrap up? Okay, so I think a quiet group today, but I think that there was so much value that you provided, Randy. So thank you so much for joining us and sharing your expertise and your insight.
Thank you. It was a pleasure. I really appreciate it.
And where can our listeners get in touch with you if they wanted to reach out?
That's very easy. It's Randy Kaufman at heronwealth.com, or you could just go to Heron, Heron, wealth.com and find our phone number there, or find me on social media where I tend to be a lot, and call, text, email.
Great. Thank you so much. And we look forward to having you back.
Thank you. It's really fun.